There we go. Okay. So here's a little more up on the slide about me, and I'll just kind of zip through. 20-year banking veteran, spent most of my time in commercial banking, but the best part about my experience has been since I left mechanics in 2015. We sold the company in 2015 to a large private equity firm, a Texas billionaire, and I took some time off afterwards. I left through a change in control because the new ownership came in. Took some time off, checked out on the beach for a little bit, and then I got bored. And I went in and I updated my LinkedIn profile. And inside of my LinkedIn were about 30 messages from people literally all over the world. And those messages were, we're interested in having you come run our company, we need your advice, yada, yada, yada. And some of those were good to listen to, some of them were bad, but I ended up pursuing about 6 of those. And one of them was an invitation from an attorney in San Francisco, Brian Cave Law Firm, who asked me to be the CEO of a startup bank. Though I wasn't interested in leading the bank as the CEO, I did ultimately engage in helping him determine whether he was going to buy a bank charter or whether he was going to form a brand new bank, a de novo bank, which led me down the path of financial technology. And wow, what a ride it's been. I'm going to talk today about my involvement in robo-advisory, blockchain, the payment space, alternative lending, and the like. I've been all over the board. So here we go. It's not moving here, guys. There we go. So we've heard a lot today about AI and kind of where this is all going, and I thought I'd play a video for you that brings it all together.
If there are billions of conversations happening every minute, imagine how many times your bank must have been talked about while you finish watching this video. Each conversation is a business moment for you to create a memorable experience for your customers that they would want to share with others. Envision the world's future. From smartphone to a smarter phone. From a car with a driver to a car without a driver. Future is the next present, where our imagination today has become Lisa's fully automated banking experience in 2020. While Lisa is sleeping, her phone receives a notification regarding the shipment, which is ready with the exporter. The intelligent software checks for funds and notifies her bank that she would need a letter of credit. Understanding an urgent change in schedule, her phone automatically resets the alarm for 7 a.m. so that she can plan her day. By the time Lisa is ready to go, her smartwatch receives a notification that her black vehicle is low on fuel and suggests that she drives the red car. The GPS selects the shortest route, and Lisa arrives the New Age Bank's intelligent branch sharp at 9. From the moment Lisa arrives at the bank's special branch with no staff at all, the door installed with intelligent communicator scans Lisa to notify the bank about her arrival. Bank's interactive walls talk to Lisa to tell her about how she can transact better with bank's offers or corporate credit. Meanwhile, her smartwatch directs her to a special kiosk where the bank welcomes Lisa, automatically logs her in, and connects her to an expert, who is a client of the bank too, to guide her about the needs for the letter of credit. Within minutes, her letter of credit is approved, the exporter receives the payment, Lisa's shipment is released, and the time is just 9:15 a.m. Rewinding to today, can you imagine the intelligent banking experience on a vacation? While Ted is enjoying his vacation, a bike, Harley, passes by, catching his attention. The bike has been Ted's dream since school. Ted takes a picture and uploads it on his social media account. Instantly, bank's intelligent software picks up Ted's interest in this bike, analyzes his post on social media, his sentiment, his conversations about the product, and after analyzing his spending pattern, the bank offers a pre-approved bike loan along with information on the best dealers around, their discounts offered, and the color options available, all on the go. While Ted is still on vacation, bank's geotagging technology identifies Ted's location, instantly analyzes his credit card spending pattern, and offers him the best deals on bike accessories at a nearby store. And this is not all. Before the vacation ends, the bank delights Ted by offering him free airline miles and complimentary hotel stay to plan his next vacation. Imagine millions of customers like Ted for a bank like yours. The intelligent software enables you to continuously track millions of social media conversations to engage, interact, and offer a futuristic banking experience to your valuable customers. Place, time, or medium no longer matters. Engage your customers. Delight your customers. NewGen products help you do just that by connecting systems, processes, people, and things of your business. Reinvent your workplace with NewGen.
Now, normally I wouldn't do a pitch for a software company, but I just had to bring this up because 3 years ago when they created this video, if NewGen would have came in and pitched me while I was at Mechanics Bank, I would have said, no way. No way. Today, fast forward 3 years, and look at what we've been listening to. This is exactly where it's going. It's becoming a melting pot of technology and innovation where everything is coming together. It's absolutely fascinating. What in this video, what's the common theme throughout the video? It's the cell phone, right? The cell phone is the gateway to the customer experience. The bank of the future will provide advice and suggestions before, during, and after a financial purchase. It's totally different than the way banks operate today. The goal will be to become part of the customer's financial and non-financial digital ecosystem, combining internal capabilities with external innovations to be a value aggregator, advice provider, and access facilitator. The bank of the future will think like Amazon and like Google, gaining insight and getting smarter with each transaction by providing services and offers in real time. The rear view perspective, or the Monday morning quarterback perspective, is, a thing of the past. This brings a whole new meaning to being proactive as a banker as opposed to reactive to the demands, meeting the demands of the customer. Now, we've all heard of CAC, customer acquisition costs. We've also heard of customer lifetime value. But what is the value of that customer? What's the value of that customer relationship? What's the value of the data? Well, I've heard numbers thrown around that each customer in a bank is worth about $400 for their data today. Gartner Research has reported that banks are leaving close to $22 billion on the table by not using analytics to harvest the data. It's anticipated that big data and business analytics software revenue will grow to close to $200 billion over the course of the next 5 years, 50% growth from where it is today. New net investments by 2020 will be in predictive and prescriptive analytics. A Morgan Stanley report on the future of blockchain predicts $20 billion just in back office savings alone in eliminating redundancies, time, and risk to just the post-trade settlement process. That's the tip of the iceberg. Disruption presents opportunities, but we're seeing this not only in financial services, but across all industry verticals, which I'm actually involved in a variety of things outside of financial services, which I'll talk about. I mentioned my involvement in robo-advisory, payments, alternative lending, and blockchain, so I thought I'd dive into those a little bit with you. In wealth management's an industry right now that's made up of about 16,000 businesses. The largest wealth manager with assets under management is who? BlackRock. BlackRock's the largest today. There's a humongous shift right now in wealth management, moving from active management to passive management, right? Through robo-advisors. We're seeing this trend. I had the opportunity to work with a robo-advisor, a startup company, a couple of years ago. Company headquartered in San Francisco, flagged in San Francisco, but the back office function was in Greece. They had 50 engineers producing the algorithms and coming up with the structure in the back office. How much do you think those 50 engineers cost the company annually for the back office function? Anybody want to wager a guess? Mykonos is where they were headquartered, where they were located. $1 million? $100,000. The break even on this business model at 50 basis points in fee income was $50 million in assets under management. I had a wealth management division at Mechanics Bank. My bank was $3.5 billion in assets. What does that mean? We had $1.6 billion in commercial and consumer loans and auto loans. We had $1.5 billion in securities. We had $1.4 billion in assets under management, about $3 billion in deposits. So that kind of gives you the mix, the flavor of the bank. My $1.4 billion in assets under management, we were averaging about 3/8 of a point on average in the portfolio. And if I fully loaded the division properly with technology overhead, we were not profitable when I took over running the bank. We had to reduce FTE to bring profitability back to wealth management. So I'm telling you that disruption is happening in all facets of financial services. This is just one. Next, payments. Payments. I mean, think about the disruption that we're seeing in payments. For the first time in history, we're seeing the unbanked be able to be banked. 700 million people came into the fold that used to be unbanked through technology, through being able to transact by mobile devices. Who's going to be the leading disruption in this area? Anybody want to wager a guess? TransUnion, ring a bell? Think about how much money is being moved in that unbanked space from people that are sending money back home. The United States is the #1 transmitter of moving money outside the U.S. The biggest recipients are who? Anybody want to? India and China are the two largest. This is a major area of disruption. I had the chance to go and do a board retreat with a startup company in the bill splitting space. This was about a year and a half ago, and we went to Chicago, and one of their board members was a senior leader at Facebook. So we went to Facebook in Chicago for our board retreat. And while there, I had the opportunity to visit with him on the side, and he said, "Hey, Christa, have you heard about Bank of America using Facebook Messenger as a single sign-on login for their customers to just transact?" And I said, "No." And he goes, "Well, let me show you." This is before it had hit the press. Facebook Messenger, as we all know, segregated the Messenger app away from Facebook for this purpose. Now there are over 1,000 payment providers that have gotten a token from Facebook that are now using Facebook as an interface for a single sign-on for customers to go in to pay bills. It's a way for Bank of America to notify their customers ahead of their payments being delinquent, as we saw in the video, to tell them to make their loan payment, their deposit balances are loaned, to cross-sell them. It's a way of really engaging with that client. I also had the opportunity to work with a mobile banking bolt-on app provider out of Australia that was looking to come to the United States. And when he came to the U.S. to tour and decide where he was going to park his headquarters, we spent about 2 weeks going around to different financial institutions and really getting a good idea of who his target audience should be. And gamification, if you're not following gamification, you should. We are behind in the United States in so many ways in the payment space compared to abroad, and gamification is hot. So look for gamification to take over customer interaction through online banking, through mobile banking. That's the next phase of this that we're going to see that's going to tie in nicely to that video you just saw. Alternative lending. I would say the biggest impact alternative lending has had is in the mortgage sector, when you can complete a mortgage app in less than 7 minutes. Even in commercial banking, you can get funded in less than 5. It's insane how quickly things are moving. I also, it's also fascinating to me because we did mortgage loans at the bank, and if it costs $300 per loan through a lending home, which is headquartered in San Francisco, to process a loan, my processing costs on the low end were $1,500 a loan and could be up to as high as $3,000 a loan. So again, there's another area of massive disruption. Lastly is blockchain. I have had a blast in blockchain. I first started out, like I said, on LinkedIn. I was seeing the feed show me, well, Bitcoin this and Bitcoin that. And I said, well, what is Bitcoin? I thought, this is interesting. So I reached out to a couple folks, ended up getting teamed up with some world thought leaders from around the world. We're called the Muskoka Group, if you want to Google us, led by Don Tapscott, who is the author of Blockchain Revolution. He's a friend of mine. And I just got really educated and got really involved, and I started exploring different uses for blockchain technology. And financial services obviously was my first entrance into it because I thought, geez, this is a major disruptor to my own industry. I don't think it's going to happen overnight. I think it's a long lead time in financial services because of regulation and consensus. Banks are not all on board with each other. Everybody's going out and getting their own patents, but it will rise, it will arrive. It's just going to be delayed, I think, for a little while in financial services. However, I'm involved in blockchain of food. I've looked at blockchain in music. I've looked at putting sensors in guitars. I've looked at blockchaining an auto reinsurer's claims process. I mean, all across the board. So blockchain's here to stay. I'm not an advocate or fan of Bitcoin, but I am a blockchain. I want to give you an idea of how I see blockchain changing financial services long term. So I'll set the stage for you. I'm a commercial banker by background, so I'm going to talk about a commercial real estate loan and how a commercial real estate loan goes through the system. There are about 40 touch points in a commercial real estate loan transaction. 40 different people touching a transaction. Seems insane, but that's the real world. Let me talk to you about why. I want to talk to you about from inception all the way through to funding. So if you have a customer that comes in, you want to form your own LLC and you're going to go out and buy a piece of real estate. You form your LLC, you manually fill out forms through the Secretary of State's office. You get them to mail you the stuff back through snail mail, right? Then you take those paper documents into your bank to open a bank account. And then you open the bank account. You provide the bank with a slew of information, personal and otherwise, for your business, all primarily in paper form still, maybe some through email, but mostly paper form. They open the new account. Then from there, it goes to the loan group, somebody in the loan underwriting. If it's a commercial real estate loan, you're going to talk to a commercial real estate loan officer. Then from there, once you submit everything, they underwrite it. It goes to an underwriting group to underwrite and spread the financials. Then from there, it goes to credit committee for credit approval. Then from there, they respond back to the customer. There's an interaction. Escrow is opened. An appraisal is ordered. There's a title report that happens along the way. There's a phase 1 environmental report. There's credit reports. There's UCCs being pulled goes to documentation. Now it's in documentation. Somebody's entering all the information on who the owners are of the property, who's guaranteeing the loan, et cetera, et cetera. Then it goes to loan funding or loan documentation. Then it goes to funding and boarding, right? And there's this whole process. At the very end of that, it goes to the title company for title recordation. Think about if you were able to do all of that on a blockchain, and you're going to hear a lot about blockchain later today. And my easiest way to explain blockchain is this. Think about an assembly line. If Toyota produced an entire truck here in Santa Clara end-to-end and didn't do part of it in some other foreign country, but all of it end-to-end was done here in Santa Clara today. Liken the blockchain to an assembly line. Each assembly line stop represents a block or a node. The end product is the truck, right? We can substitute that truck with a token, can substitute it with a piece of real estate, can substitute it with a piece of jewelry, whatever you want to digitize it as a digitized asset. That's how you want to think about the blockchain. In the event blockchain comes to life, we blockchain county records, we blockchain Secretary of State filings. All of that stuff gets automatically pulled down between a public and private interaction in the cloud, right? We circumvent the need for title companies altogether, because why do we have title insurance? We pay title insurance to insure against the title company's risk. It's crazy, but we do. So that's how amazing this technology can be. I'll share a quick story with you over something that's kind of funny, actually. What you're trying to solve for is redundancies and speed. I'm like an operational fanatic. I like to take something that takes 40 steps and drop it to 5 or drop it to 10. We had a new accounts representative, this is a long time ago, like 15 years ago, who I provided new accounts documentation to open an account, and I asked her to order checks and mail the checks to the new customer. Customer's name was Mid-State Steel Erectors. So she opens the account, she mails out the checks, and I get this phone call from the customer. And she says to me, Christa, I said, yeah. So I have a problem. And so what's the problem? She says, well, I got my checks. I said, okay, good. Are they all right? She goes, well, no, not really. She said, the checks say Mid-State Steel Erections, not erectors. So we gave Mary a bad time. But had that been able to be downloaded if you will, or drop down from a public cloud environment from Secretary of State directly fed into the bank, guess what? There's no redundancy, there's no room for error. It would automatically feed. So that's the power of this technology that we're going to see coming forward. However, all of this innovation comes with its challenges, right? I mean, nothing's perfect yet. So, what's the holdup? Why is it taking banks so long to adopt to new technology? First, let me differentiate why this says community bank and not big bank up here. Because this slide could be interchanged with anything we've already talked about. It could be robo-advisors we're talking about. It could be alternative lenders. In the instance of time, I've chosen to hit upon community banks. So, an overview of the banking system today. There's 5,700 banks in the United States, about 6,000 credit unions, but the credit unions are a lot smaller. 5,700 banks. Top banks, JP Morgan, B of A, Wells Fargo, and Citi. They're the monsters in the room, right? And then it drops off substantially from there. Most of the banks in the United States, close to 5,000, are below $1 billion in assets. If you remember, bank I ran was $3.5 billion. We were in the top 500 banks in the country. We were actually, I think, ranked around 220 in asset size. That seems hard to believe, really, when you think about the mass of the financial system. Because what that shows you is there are a lot of community banks below the belt, a lot of community banks, most of which are the ones that entrepreneurs are targeting. Because as we know, and I think it's safe to say, big banks are doing their own innovation. They might listen to the entrepreneur and have them come in and do a pitch, but most likely they're stealing their ideas and building it out on their own. So the target is usually going to be this environment for the entrepreneur. There's the challenge with banks are these three things: denial, knowledge, and resources. And really, denial is they don't believe it's impacting them. So many of my peers, they're not even paying attention. And I can say I was like them 3 years ago. I had my head in the sand. I was just busy doing what I was doing. I wasn't paying attention to what was going on around me. Leadership's not looking beyond the tenure of the C-suite. We've got an aging C-suite in the financial services industry. There's a big gap between the age of 35 and 50 today in leadership. That's going to have a massive pivot and massive change. There's also a requirement for a board refreshment. The boardroom is dated. A lot of board members aren't even using cell phones. How are they going to be able to help set the direction of the company if they're not even using cell phones to access the internet or check email? Knowledge. They're unaware of the technology initiatives going on around them. There's no defined digital strategy. They're hearing, well, we need to be digital, but they have no idea how to do it. They don't understand the existing infrastructure that they have, and what's working and what's not working is where digital begins, is you have to understand what you have. And there's no use of customer data. We saw where customer data is worth $400 a person. That's valuable, but they're not harvesting the data yet to predict how the customer is going to behave. Lastly is resources. There's not proper staffing to carry out the required change. They lack internal versus outsourcing assessment. They're not even paying attention to, they're doing no assessing of the outside world of what the competition is doing. And nobody's paying attention to contracts either, and contract negotiations and the length of the contract. So those are big hurdles that we in the entrepreneurial side and the startup side have to educate and get over the hurdle threshold to even get in the door to visit. You have to convince them that there is a reason why you're there. A little hint, if you are an entrepreneur, you want to be targeting banks that are somewhere between $2.5 billion to about $20 billion in assets. The smaller ones are not going to have the money. They're not going to have the financial resources or the people. So they're going to be more hand-holding going on. The smaller ones, a lot longer lead time. So just be cognizant of that. Likewise, on the other side, why is it taking so long for a startup to execute on those promising contracts? Here are some common themes among startups. It's a great idea, but you haven't been able to execute. You might be in the door, but you're having to give away your product. You're not making any money yet because you're having to demonstrate to them that your product will work. And your system is running parallel to another system on the bank's platform. And you've got a year or two lead time. You've not analyzed the existing infrastructure well. You don't know how that bank operates, what platforms they already have, how many vendors they have hooked into the core. Does that core provider have an open API or an API where you're going to link into them? I don't know. That's something you have to consider. You're not able to access the true decision makers. There's a lot of banks right now that are quoting that they're innovative, and they're saying they're sending people to innovation conferences all over the place, but those aren't the decision makers, and oftentimes those decision makers never get in front of the C-suite to even tell them what's happening at those conferences. Lastly, you run out of money. You fail to monetize before you're outside of the capital that you've raised. That's another just dangerous place to be. So, there's challenges on both sides of this thing, but I really do believe that fintech is here to stay, and we're starting to see this gap being bridged between fintech and bank partnerships. We're also seeing this gap converge right on this melting pot of social technology, social media, to Amazon, to Chase, to whoever. We're starting to see it all kind of mold together. That will help bridge the gap, and it'll help keep fintech alive ultimately. What was once thought and portrayed as fierce competition to the banks has subsided. The prime example of this is SoFi's Super Bowl commercial. If you saw it, it was, they were not a bank. Well, now they're partnered with the bank to offer a deposit checking account. So it's coming, it's changing, it's evolving. Early partnerships that we've seen early on was Chase and On Deck, Lending Club with various community banks. But after Lending Club had its debacle, a lot of the community banks ran from Lending Club and put the brakes on doing anything with Prosper or any of the other ones. We're starting to see that come back around. We've seen Goldman Sachs and Wells Fargo build out their own platforms. The market saw early buy-in from private equity player BlackRock, the largest fund I mentioned earlier. They made a move a couple of years ago to acquire Future Advisor as an app aggregator and money manager who provided automated robo-portfolio management. A new breed of partnerships are emerging, and not just between banks and fintechs. We're seeing Zelle. Early warning is apparent to Zelle. Zelle is now trying to break in. Well, they're doing a great job, but they've had their issues, right, with security. But they're trying to combat Venmo and PayPal's, take on debit card transactions. And so we'll see how that goes. Facebook Messenger, I mentioned, teamed up with Bank of America and others. You've got consolidation going between banks, lots of M&A. I own an investment bank in Atlanta, Georgia. We're the market maker for about 800 banks across the country. We buy and sell between banks. We're in the middle of doing an IPO right now that we announced a few days ago for a bank. And we're seeing consolidation in the industry, but we're also seeing it in the fintech world too, where fintechs are merging together. So there's gonna be more and more of that happening. There's no doubt that there's a fintech bubble, and there's a big difference between bank valuations and fintech valuations. So it'll be really interesting to see what happens over time as banks invest in fintech, or will banks acquire fintech, or how will that come together long term? So 2018 and beyond, the future is bright if you embrace it, and we're seeing that happen. My favorite quote of all times is, "Vision without execution is hallucination," by Thomas Edison. I think it's safe to say that strategy without execution is hallucination, but also suicide. And we're seeing a lot of companies, banks and fintechs, that if they don't have a good strategy, an executable strategy, they are just not going to get the traction. They're going to be stuck where they are. The goal of banks and fintech providers today and beyond should be to become the digital aggregator and create the value by offering quick, secure, and easy to use products and services. Be a real digital concierge. Be willing to change and recognize technology is changing faster than it's ever changed before. Artificial intelligence and blockchain is just starting to take shape. And there's no doubt that in 3 years, this whole competitive landscape we sit in today will be different. We need to increase customer interaction and engagement by offering easy-to-use, quick, and secure platforms. Engage and delight customers by connecting systems, processes, people, and perspectives. All of this comes with a change in mindset, a mindset of analytics. Use the data you have at your fingertips to identify the problem and figure out how to solve it. Look for quick wins and don't get stuck in what I call analysis paralysis. Make sure you have the right team in place and the right boardroom. And lastly, set a vision for how you want to see yourselves fit into this new world, into this new digital footprint. And disrupt yourselves before you become disrupted. Thank you. Anybody have any questions? Are you all hungry? Oh, question? All right.
All the changes are happening around the fintech and AI and all of the technology space. What is your thoughts? How, as a career professional, they can be prepared, like in order to accept these changes or be part of these changes?
So your question is, how do you be a part of the movement in technology?
Right. What are the career professionals, like as a career professional, they can do? They can take the next steps. Is it a new training or reading materials or be part of some startup ecosystem, or what are your recommendations will be?
Well, first of all, I think that the new banker, and I'm looking at the next 3 to 5 years, the new banker is going to be the quant. It's going to be the person that's doing that's the building out the algorithms. That's where banking is going. So if you have kids in college, like I do, that's where you want to be telling them to have their focus is. Have them focus on predictive analytics. That's where the future holds. That's where the future is. As far as how do you get involved, I was really fortunate because I had the opportunity to work with a bunch of startups, and it was great. I mean, I had a great time, although a lot of them ended up sucking me dry of my time, but it was great for me because I learned a lot. I'm not a technology expert by any stretch of the imagination, as you can tell with the clicker today, but take the time to get educated. I don't think you need to be a technology expert. I think you need to be able to connect all the dots. The biggest gap we have with technology today, with fintechs, is you've got great programmers and developers, but then those folks can't connect the dots to how it gets actually implemented into, how it integrates into the core of something already in existence. And then really being able to have that macro view of something, of how it's going to work, the cause and effect of doing something, I think is mission critical. Because if you miss the cause and you miss the effect, you can miss the boat. Any other questions? Thank you.